Hello, everyone. Today on the final bar, my guest is Javed Mirza. Javed's the technical analyst at Canaccord Genuity in Toronto. The S&P really chopping around, sort of sold off in the morning, made it back to level ground midday, sold off again in the at the end of the day. So while yesterday's session we had an accumulation, we had an appreciation right accelerating into the close. Today we have sort of the opposite, bit of distribution, but overall plenty of charts continuing to go up and to the right. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a snowy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, focusing on the message of the markets themselves, the message inherent baked into those charts, which tell us sort of the aggregate supply and demand, the aggregate fear and greed, the emotional sense of where investors are at, and netting all of that out into the price of stocks and ETFs. The goal of our show, and really of anyone using charts as an investor, I would argue three things. First, identify trends. Number two, follow those trends. And number three, have a toolkit that anticipates when those trends are exhausted. And hopefully through the course of our show, over time, we're able to hit on all three of those and help nudge your own thinking on how you're able to identify those systematically with your own investment process. We have great guests that come through the show. Excited to talk to Javed Mirza from Canaccord Genuity today. Tomorrow on Wednesday, we have Clint Cowles from TD Ameritrade in Minneapolis. On Thursday, Larry Tentarelli from Blue Chip Daily. Coming up next week on Tuesday, the 16th, we have Gary Dean from Sentiment Timing. So again, a lot of my conversations with our guests, it's always just interesting to hear just a quick, brief look inside their own process, what they are using to try to make sense of these markets. Now, one of the great things about a lot of these seasoned investors that we talk through is they've developed really good processes, really good routines over time. So my question in the poll that we asked you recently really touches on some of the things that can cloud your investment process, and all of us really as investors. We ask you, you decide you're bullish, then you start looking for evidence to support your thesis. Which behavioral bias are you demonstrating? And congratulations, Final Bar Nation. Well done. Almost 4 out of 5 of you, actually just over 4 out of 5 of you answered correctly. That is confirmation bias. The idea is you gather evidence to confirm what you've already decided ahead of time, right? You already made your call. Now you're just trying to gather evidence to raise your conviction level, to feel better about the decision you've already made. And hopefully what we've talked about is to try to flip that routine, right? Start with gathering evidence, approach the markets, approach the chart with an unbiased opinion. Focus on what the trends are. Focus on the analysis, the conclusion of your process, and then use the weight of the evidence to determine what the market is most likely going to do. Bullish bias and bad idea bias, I totally just made those up. So sorry for tripping up a number of you. Endowment bias is similar. It's related to that, but it's basically where you hold on to things too long. You have a position that you love. You love Home Depot. It's been such a great stock, such a great performer. And as Home Depot goes lower, you justify owning it, even though it's no longer a good position for you. You just have an emotional connection. And as a result, you hold on to it too long. So it's one of those things that may cause you to sell too late sometimes if you hold on to things too long. Let's continue on with our market recap. As I mentioned, if you could look at the little preview chart, you can see sort of the configuration of the last 2 days, sort of an inverse of what happened yesterday. I would argue that, yesterday you really chopped around in the morning and then accelerated to close higher. Yesterday's close just above 39.15. Today we actually traded around and then it sold off going into the close. But the S&P essentially finishing flat, closing around 39.11. Mid caps and small caps doing pretty well. Small caps sort of accelerated to the upside. One of our questions coming on in our mailbag segment later today specifically deals with the relative strength of small caps, and we're certainly seeing that continue. Looking at some other asset classes, bonds essentially flat. If you look at the TLT, they sort of gapped higher in the morning, but closed back to be flat for the day. 10-year yields around 1.16. Commodities, you have commodities continuing to strengthen. The DBC, as we highlighted recently, is continuing in a pretty solid uptrend. Gold and silver actually mixed, the GLD higher, the SLV lower, and the energy sector was the worst of the 11 S&P sectors, down just over 1% today. Cryptocurrencies continuing their run higher, Bitcoin up 1.5%, closing above 47,000. Let's look at a chart of the S&P 500 to talk about the big picture, what we're seeing here. So, as I've probably mentioned ad nauseum over the course of the year plus we've been doing the show, is higher highs and higher lows are an uptrend, lower highs and lower lows are a downtrend. So if you do nothing else as a technical analyst, I hope you look at a chart and define what I would call Dow theory. Are we in an uptrend or a downtrend? Start with that. All the other stuff is just stuff to validate what you just decided, or not what you decided, but you just learned by defining the trend. When I look at a chart of the S&P, and when you zoom back, you can see an acceleration out of the March low. You can see a consistent pattern of higher highs and higher lows. That changed in September and October of last year. We have a consolidation pattern and narrowing of the range of lower highs and higher lows that was resolved to the upside in November. And the market has essentially not really looked back with a pattern of higher highs and higher lows. We had a bit of a head fake there at the end of January. And you certainly heard me talk about the 50-day being in play, breaking below the swing low, breaking down through this trend line support. That was all sort of on the negative territory. And on this Friday, the comment was, or the thinking was, do we follow through? Do we get validation of a breakdown through the 50-day moving average? And we really have not. We turned on the Monday afterwards and have continued higher, essentially unabated. So we've now once again made a new all-time closing high for the S&P this week. The trend is higher until proven otherwise. What's interesting looking at a chart of the S&P, potential bearish divergence here. You sort of had that in January with higher highs in price, lower peaks in RSI. February has fallen off the chart. But that's sort of what you saw on February with the market going higher, the momentum starting to weaken out a little bit. If we continue higher here, it's interesting to see if the RSI remains below its peak from the third week in January. That would confirm a further bearish divergence. But overall, again, divergences happen a lot. How much they actually call the top, a lot less. And if you think of charts like Tesla and Plug Power and other high-flying names that we've seen rallying in recent weeks and months, a lot of them have had divergences along the way. They've all resolved to the upside so far. The kicker, I think, with the chart is to focus on when a breakdown happens and when you get follow through, and that's what we certainly have not seen yet for the S&P. Looking at some other themes here today, we have real estate, the number one sector. So the S&P sort of chopping around, but REITs being the number one gainer. Real estate's one of those sectors. It's a relatively small sector. A lot of people don't think a lot about it because it's not a lot of stocks, not a lot of tickers you probably know. And for years, real estate was wrapped into the financial sector that broke off a number of years ago into its own. But overall, these are high yielding stocks, and they're not homogenous. They a lot of them do trade together. There's a lot of different bets you're making when you look at REITs. So worth paying attention to, especially if the relative strength starts to improve. REITs and utilities, I find people don't naturally gravitate toward. Focus on the charts, and if they're working, you want to be there. What underperformed today, energy, materials, consumer discretionary, 1, 2, 3, coming off the bottom. In terms of some group themes very quickly, and then we'll continue on with a couple other charts to note. This group, renewable energy equipment, it just traded here at the top, but overall one of the strongest groups. This is the group with solar stocks, hydrogen names, a bunch of sort of a mix of things. Sort of the clean energy trade overall has been obviously exceptionally good. It's worth noting a couple of these are within the industrial sector. This is a sector that I think a number of us have sort of gotten away from. Delivery services, which I remember, right, that's UPS and FedEx in that group, doing pretty well today. What underperformed? Coal's a pretty small group. We'll skip that one, but it tends to be a little volatile. Airlines actually rotating back lower. A lot of travel-related things on the bottom here, hotels and so forth. Home construction. This is the home builder group. I wanted to bring that up here very quickly, just to highlight it. There's a couple XHB and ITB are the two. So these are down a little bit today, but this is after hitting new 52-week highs, if not all-time highs, on a lot of these stocks. We highlighted Lennar recently, and the ITB is a pretty pure look at home builders, and you can see just again making a new closing high yesterday, pulling off a little bit. And overall, this is why we take a step back and we look at the trends, look at the peaks and valleys as the trend emerges. We had a rally, we had a consolidation. I would argue this is back to a bullish phase of continuing higher. The relative strength starting to improve. So worth looking as this would pull back. Does it remain above the previous swing low? Does it remain above the 50-day moving average? Those would be the questions that I would most likely be looking to answer. Airlines have been a challenging group. It's interesting when you look at Jets, which is an airline ETF, testing its December peak, around 24. So getting above that level would be pretty meaningful. Had a nice rally there in November, and I think which is where a lot of people started to believe this could be the reemergence of airlines as they get above their June highs, as many stocks already had. But since there, from there on, it's been a pattern of lower lows and really, struggling to gain any traction. Be interesting to see if we're able to get Jets go above its December high, rotate back to a pattern of higher highs and higher lows, start to improve, see if the relative strength can improve. But at this point, I'm super skeptical of a chart like that until it proves itself. Where we are seeing some nice movement is with the biotech ETF. And again, these are groups that have actually struggled a little bit today, but overall, on a relative basis, the trend very much stronger. You can see with the IBB, a number of these pushes higher have been overbought. When it's pulled back, the RSI has remained above 50, and that's really sort of a pretty strong uptrend. That's where the RSI can be helpful, not necessarily for a trading strategy, but just to explain the nature of what's happening. Higher highs, higher lows at the RSI consistently becoming overbought. Overall, tends to be a pretty strong long-term pattern. We need to take a quick commercial break. Back with my guest, Javed Mirza. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we look at the message embedded in the markets, focus on the charts and what we can learn by the illustration of investor psychology over time. As a reminder, we have a number of times during the week where we get to answer your questions. It's called the Final Bar Mailbag. We'll do another one of those segments later in today's show, and we'll do another one at the end of this week. We'd love to answer one of your questions on the air. You can get your questions to us three ways: via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on our YouTube channel. Just put a comment below the video you're watching. We'll gather all those questions, hopefully answer one of your questions in our next mailbag segment. I want to welcome on my guest to the show, Javed Mirza. Javed is the technical analyst at Canaccord Genuity in Toronto. Javed, welcome back to the show.
Thanks so much for having me, Dave.
So we started talking before we kicked off the show, just talking about cycles, and you're absolutely right. We don't have a lot of discussion about cycles, so I'm really excited for you to start off and just think about where we're at, relative to sort of the bigger picture. Talk us through these first couple charts here, cycle related.
Perfect. So one of the big things in technical analysis is going through price history and seeing what's happened and kind of where we're going. And that's a big thing of what I do is I'm always trying to position clients for where we believe the markets are going. So one of the things that I've heard from a lot of people just over the course of the last couple of months is that we started a new cycle back in the pandemic lows around March or April. So what you can see here, the dotted line is the average track of the 4-year cycles. So for those who aren't aware, going back to the 40s, there is the business cycle, which is, it goes through the phases of expansion and contraction. And that's reflected in the stock market. And every 3 to 5 years, like clockwork, the stock market makes a major low. And that is the contraction phase of the business cycle. So what I want to highlight here is exactly where you've got the cursor. That's what the red line is, what the current cycle looks like if we were there. And the dotted line in the middle there, that's the average track, exactly, thanks Dave, of these 4-year cycles. Now, if you take a look at the next slide, here's what we think is actually going on. So in December 24th, 2018, our view is that the stock market made a 4-year cycle low. And then you can see for the course of the first year, it tracked the average cycle pretty closely. Then in February, we had the pandemic. We had that sharp drop. The Fed stepped in and governments around the world, and they did a fantastic job. And after that, we had that regression back to the mean. And notice that the target that we highlighted at the start of last year was 3,700, and we came right back to it. We actually closed the year at 3,755. But Dave, if you give us a day, then we actually closed on the first trading day of the year at 3,700. But the numbers don't matter. It's just the general track. But the point I'm trying to make here is it looks more like we're back on the average track of the 4-year cycle, which, as you've discussed, we've been telling clients started in December 2018. Why is that important? Why does that matter? Well, we're getting to the end of this 4-year cycle. And in our view, we're going to see the 4-year cycle reset. That's the contraction phase of the business cycle towards the end of this year. And I'm sure, Dave, you're seeing it. There's people who are trading stocks and opening accounts that normally you would never see. I know I've had friends asking me who never asked me about financial issues or stocks. So in my mind, we're getting towards the end of this cycle. We're not starting a new one. So a lot of this euphoria that we're seeing and a lot of this movement, we think the first half of the year out into the summer is going to be good, and that will lead to a 4-year cycle peak. And then we're going to see the second half of the year, I think, and our work suggests it's going to be quite choppy. So if you take a look on the next slide, and this is just the chart of the S&P 500. Dave, I know you've been going through this for a while. So right now, this chart remains constructive. As you pointed out, Dave, we've got a series of higher highs and higher lows in place. That is all very positive. The red bars there highlight when we've recently hit sentiment extremes. You can take a look at the third panel, investor sentiment, and the fourth panel, that's the put-call ratio. I'm sure, Dave, you've drawn attention to that recently as well. Okay. But the point I'm trying to make here is that I think it looks like we're set up for one push higher into the summer, but it's likely that last push higher into the summer is likely to signal the peak of the cycle that began in 2018. And if you take a look at the next slide, and I know you were talking about this earlier today as well, it's the TLT. And what I want to highlight there is just, you can see us coming back down to this, that 143 level. So I think that at the very least in the short term is where we're going to head back to. And potentially in the summer, we could come back all the way to that 133 level. So that says to us that yields towards the end of this, towards the summer, are going to be around 150. So that would be quite constructive for broader markets. But we also think that's going to be the market peak. And that red line you can see there is the 4-year moving average or 200-week moving average. And that should be pretty strong support. So what this is telling us, the TLT still has further downside. The trend is definitely down, but which should start to stabilize once we get to that 134 level. And we think that's going to be towards the summer. And that should line up nicely with the market forming some sort of bigger 4-year cycle peak. And then finally, last but not least, one of the things that we're looking to corroborate this is the LQD. So recall in March, April, the Fed stepped in, they backstopped markets, adding liquidity, and they were actually buying this instrument. But notice after that bottom, notice what it's done here over the last couple of months is it's effectively started to pause and go sideways. So if you take a look at the thin blue line there, that's the 40-week moving average. And it's effectively similar to the 200-day moving average. So it's something we're keeping an eye on because, as Dave is well aware, once you start seeing cracks in credit markets, it's only a matter of time before it starts to flow through into the broader equity environment. So one of the things we're looking for is, I think in the summer, we're going to get to a point where we're going to test that 131 support level and actually break through it. And that is going to signal to us that we're entering the contraction phase of this 4-year cycle. And the second half of the year is going to be choppy. So as we get into the summer, I think what you're going to see is the more defensive sectors that have been under pressure now, REITs, utilities, consumer staples, they're going to bottom, they're going to turn up as portfolio managers begin to rotate out of risk on and into risk off.
Joe, that was just an awesome 5-minute walk through a well-articulated thesis. And I love it. As you were mentioning sort of the, euphoric stage, the word frothy has escaped my lips occasionally in recent weeks.
I figured as much.
Right, just recognizing it. But I think you make a decent case for stronger stocks, weaker bonds going into the summer, and then sort of that risk on tapers off and you get more of a risk off look. We'll have to see. Javed Mirza, such a pleasure to have you on as always. Wish you and those around you stay safe, and we'll talk to you again soon.
Thanks so much, Dave.
It's Javed Mirza. Javed's the technical analyst at Canaccord Genuity. Talking with someone like Javed, I've always enjoyed following his work, and he talks through a series of charts and reminds me of others that we've had on the show, people like Tony Dwyer and others that articulate sort of an overall thesis so beautifully. And you can get the relationship of the strong price trend, the improving breadth, but also the sentiment. We're reading just the anecdotal sentiment that feels, frothy, euphoric, depending on what adjective you would describe. But I think what's most important, one of my takeaways, thinking of that interplay between stocks and bonds, what that might look like now through mid-year, what rising rates might do for things like financials and other areas of the market, and then what a risk-off second half of the year might look like, with a nice tease on the cycles as well at the beginning. We need to continue on here and go on to the final bar mailbag. I really appreciate all the questions that you guys have sent in over the years and recently. These are all questions in the last short while here. Let's talk through some of these questions. Number one, do you have any guidance on how to invest in stocks in EFA, EM, and China? Other than the main ETFs, I'm not sure where to look. Even if EFA, EM, and areas of China will outperform the SPY, I still feel I have a better shot at picking individual stocks within the US market and balance that with some non-US ETFs like EFA, EEM, and ASHR. It's a great point. And I don't have a ton of time to answer all of the question that you asked there, but you'll notice I tend to focus on this candle glance page, the global equity ETFs. It starts with sort of the broad measures, U.S., global developed, global emerging, frontier markets, and just seeing what we can see there, and then looking at individual countries below there. Now, a lot of these countries, have stocks that are traded in the U.S. that are listed in the U.S., especially something like Canada. Japan to some degree, China. I mean, you can certainly access, non-U.S. companies that are traded in the U.S. using their U.S. counterparts or the U.S. listings of their stocks. I think you've hit on probably the best argument for global ETFs, which is if you are going to make a bet on an individual Japanese company, you better have a really good sense of the Japanese economy and the sense of where things are headed, the yen and its relationship to the dollar, the government and how they are handling things there versus elsewhere, and then use that as part of your mosaic. I know from working at a large investment firm, you had people on the ground in Japan, and you had a sense of what the Japanese central bank was most likely to do, just like we would focus so much on the Fed here in the U.S. So I think if you are able to devote the time and resources and energy and surround yourself with enough resources to really be able to focus on individual names, you should do it. But for most of us, that's probably not an accurate description of our skill set. So I would focus on where you're comfortable. Focus on U.S. listed names. But remember, on something like China, there are plenty of names like Baidu comes to mind. It's one of the top ranked stocks, and it's still in our mid cap scooter ranking. It's appreciated so much. It certainly is deserves to be in the large cap universe for sure. It was pretty small back here, middle of last year. But these are there's a Chinese company listed in the U.S. So I would look at some of those opportunities to analyze stocks U.S. listed that you would know from outside the U.S. But I think you've hit on it. Focus on ETFs when you can. I think you're in pretty good shape. Next question. Sounds like the energy sector is going up. Past says the end of February is the period energy will start going down. Are there any charts to know the past performance and monthly performance bar charts? Have a great week ahead. It's a really good question. And, it's funny, I didn't, as I was looking at that question, I didn't think about what Javed was going to talk about. My guest, he focused on cycles a little bit. If you click on at the top of StockCharts where it says Sharp Chart, if you click on that and switch to seasonality, you can type in whatever you want. There are a couple sort of best practices I would tell you. Number one, when you start here, I would bring in a little more data so you can go back to 20 years of data. And this is basically showing you every month going back, what percent of the time, sort of your batting average, what percent of the time did the XLE close higher than it did than it opened if you go back through each one of those months. And so your comment was February is when it starts to go down. If you actually look at the seasonality, the XLE tends to do okay February, March, April, and then it starts to have a struggle a little bit during the middle of the month, middle of the year. You can also do a relative look, and this is where it gets really interesting. So now we're looking at the relative performance of energy versus the S&P 500. So how well does the XLE do relative to the S&P month to month? And again, same thing, March and April actually better than average, and then it gets worse through the remainder of the year. So you can use these seasonal charts to actually look at the data and see how well does a stock and ETF tend to do. And I would encourage you to put the relative on there to see whether relative outperformance or underperformance, there tends to be a cyclical pattern. Again, you're making huge assumptions when you're looking at this, and you see 58% of the time energy's outperformed in April. There's no guarantee that this April is going to be along that ride, but it gives you a sense of the averages. Next question. Great show, Dave. A few weeks or months ago, you discussed IWC, the microcap ETF, said you liked the look of the chart. I did too when I took a position. I was wondering why microcaps outperform small caps who outperform mid caps. Is it something real like reversion to the mean because small caps took it on the chin more in the 2020 drawdown, or a self-fulfilling prophecy that small caps outperform in a recovery? That is such an awesome, nuanced question. And I'd love to answer all of that. So is there a relationship? So, there are different ways you can do this. This is one of my favorite charts to do, and it's pretty easy to set up. I have the S&P is what I created, and then I added an indicator just called price, and I put this ratio of the IWM versus the S&P. So here I'm taking out of your question just small versus large to illustrate. You could easily do micro versus small, small versus mid, whatever combination you'd want to, or a bunch of them. Stack them all up here. But this is a great way to see when the market does one thing, what does this ratio tend to do? And if you take a step back and just look overall, what you're pointing out kind of makes sense, which is smaller companies tend to do better than larger companies in bull market phases. They tend to underperform in bear market phases, generally speaking. And part of that is because they're higher risk, they're higher beta, they're smaller names. And so they're more opportunistic. So when people are making a risk-on bet, taking on risk on their portfolio, they tend to look further down the cap tier. They get away from the high, big blue chip names that go down the cap spectrum. That's why smaller companies tend to do well. You also, I don't have the US dollar on here. That's another headwind and tailwind, the strength of the dollar, because that will affect a multinational versus a US company that has really very little non-US exposure. What's interesting though, is if you look at 2019, for example, there's been a theme here, for a year and a half, 2 years, where small caps were underperforming consistently. This is sort of the FANG trade. People compared it to the Nifty 50 in the 1970s, where a small group of mega cap stocks really were the market and everything else was sort of trying to play catch up. That was sort of, we talked about FANG leadership, narrow leadership was during that time. But if you start the clock at the March low, look at how small caps have accelerated to the upside. That's partly a US dollar thesis. That's partly a risk on thesis. That's financials and energy coming back. It's a lot of different things. So this is not just a simple relationship with these two things, but this is the chart I would use to try to put some data behind the comments that you've made. And in general, I would say it's all the above. I would say it's weaker. US dollar has certainly helped this trade. It's risk on that is accelerated. And, people speculating and going into some of these lesser known names. These are smaller cap stocks, micro cap stocks that are emerging. We need to wrap the show quickly. Go to the 3 and 3. I'll do them as quick as I can, so we can hit our timing mark. Chart number 1 is the S&P with new highs and new lows. I just want to point out that we've mentioned the skepticism of a market going to new highs, but with a lesser number of stocks making new highs. You've actually seen that reverse. In February, you've seen an increasing number of new highs as the S&P has rallied, and it's a lot of companies making new highs as well along with the market. That's a constructive thing. Chart number 2, playing on that small cap thesis we just talked about, is the US dollar. So we've talked about the strengthening US dollar so far year to date that potentially has changed. We had a potential change of character as the US dollar, the UUP, has broken down through that trend line support. The US dollar index most likely is going to look the same way. So potentially continuing this weaker dollar thesis that has been the norm for much of the last 12 months. Finally, I mentioned stocks breaking out. Things like Baidu doing just fine, breaking to new highs. Biotechs are the group I would highlight today. When you look at stocks that are working, biotechs are a pretty good example of that. When you look at the last 2 years, you can see the consolidation in mid-year going into the fall, but then this nice breakout pattern that's just continued as it broke above resistance from July. And I love the relative strength that's been relatively solid for the last 6 months. Folks, that is our show for today. Special thank you to Javed Mirza from Canaccord Genuity. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.